Good afternoon, everyone. Bill Ulivari here with Cenacle Capital Management. Today is January 25th. It is 1:15 in the afternoon. And I just wanted to do an authentic fireside chat to talk about the market and some of the things that I see going on in the financial news media versus what's actually happening with price and time. So let's just review a few things. All right, number one, we're all concerned about the spending bill, the $1.9 trillion stimulus spending bill. And it seems to be a no-brainer that you just have to go out and buy the market, right? Government spends, it's inflationary, let's just go out and buy everything. Let's go buy stocks, right? And it's a no-brainer, we're gonna make money. Take it to the bank, it's a done deal. People are also talking, and news media talking about the collapse of the US dollar, that we're concerned about higher inflation, and perhaps that's going to lead to higher gold prices. We're worried that our shopping malls and strip malls are going to collapse and are going to be empty, vast wastelands of property, and that the US government is in way too much debt. These are the things that I'm hearing in the conversation. But what's really happening? So let me share my screen with you, and I'm going to move some of my charts around here and click screen share. Let me show you what I really see. So the first thing that I see is, let's take a look at the S&P 500, all right, SPY. So you can see from our COVID lows in March and April of 2020, we have just staged a spectacular, very steep rally. And it's the steepness of this rally that I'm concerned about, not the fact that we rallied. Because you might remember, I was warning about the market being overbought in November and December of 2019. We held cash until about March or April, and we were able to deploy it in that time period. And now, we sold a little bit in June of this year. I will say that maybe we unloaded a little bit in this time period. But anyhow, you can see that whenever you go back in time, when the market kind of pops its head above this upward trend line, that we usually experience a downturn, right? It's a little bit overdone. Now, these lines I drew using the charting software, they don't technically mean anything. It's just sometimes it becomes a self-fulfilling prophecy where support and resistance lines are because of transactions that happened weeks, months, years ago. So again, I just want to say that for the most part, we've had an amazing rally going back to 2016, actually. But for the most part, the COVID low recovery was way too fast, surprisingly fast, and certainly caught everybody off guard. So here, down here, nobody wants stocks. Now everybody wants stocks. Very interesting from my perspective. So let's take a look at gold, right? We're worried about higher inflation. Everybody's talking about gold. Well, the gold market, if you take today's price and go back in time, you'll see for the most part, the price of gold today at $1,740 an ounce is right where it was at the fall of 2011. So gold really hasn't provided that kind of flight to quality, that protection for investors. As a matter of fact, if you bought gold in 2011, you're probably down about 30% in your purchasing power over time. So that's something we have to be concerned about. Again, I'm not all that into gold. I think a little bit is okay for your portfolio, but you can't own a lot of it. As a matter of fact, I'm really concerned that we might see lower prices in gold, because gold usually declines when the US dollar rallies, and that's what I want to talk about next. So let's go back to this chart over here. Not necessarily in the exact order that I would like to do it. Here's a chart of real estate as guided by the Dow Jones Industrial Average US Real Estate Investment Trust. So these are strip malls, shopping malls, cell phone tower companies, storage units, anything where the company builds a piece of property or provides an asset and then rents it out and collects income. So you can see here we are today. This is 2020. And if you go back in time, the real estate index is about the same level where it was in 2007. Isn't that interesting? So real estate, commercial real estate, hasn't really gone anywhere since 2007. Very interesting. Now, you would have been receiving a 2.25% dividend stream over that time. But for the most part, we had this huge shellacking, this huge sell-off from 2007 into 2009, the Great Recession, a great recovery into the end of 2018. And again, I think this is this slowness here, this consolidation, really speaks more of consolidation and slowness in the economy, not a super hot economy, a super firing economy, one that's really growing. So I'm a little bit concerned about real estate, commercial real estate, in terms of how it's going to be performing as it gains, right? Not in the dividend stream that perhaps it will be providing. The next chart here I'd like to take a look at is the US dollar index. Everybody's talking about the collapse of the US dollar. Well, here we are showing my screen with you. You can see that the US dollar has already been declining for almost a year. It got as high as it did maybe at the right after the President Trump administration, higher US dollar. Perhaps it was a flight to quality. I'm not really sure. But you can see that we're kind of in the middle of the range. We could, again, return and go up higher due to higher interest rates, which is what I think is going to happen. Or perhaps the market will sell off more in the middle of the range where it was during the Obama and Bush administration. And again, we're only talking about perhaps less than a 10% or an 8% decline in the US dollar. So for the most part, yes, we did kind of break through this trend line, this support area where I think traders and investors and international foreign exchange people were looking at it. But for the most part, we're not really seeing this collapse as everybody's speaking about. And as a matter of fact, if we tighten up the scale and look at the short-term chart, you'll actually see the market in the US dollar had a great sell-off since the spring of this year, pre-COVID. And then now it kind of looks like it's consolidating. It looks like maybe we might actually be rallying a little bit. So again, be careful what you listen to on the news, especially the financial news, because it's more clickbait information. And I think our time is just about up. So I'm going to stop the screen share and come back to you guys here. So in conclusion, what I would like to just mention is sometimes successful investing really means that we go in the opposite direction of what the financial news media broadcasts and what our friends are talking about. What seems to be a no-brainer is never a no-brainer. It's usually the no-brainer is to do the opposite of what everybody thinks. We have to be very patient investors here because, again, the market is kind of at a crossroads. You know, we always have that sell in May and go away, and actually it's more like sell in March and go away. And the truth is, we're at the end of January, we're almost 1 month away from the sell signal on a seasonal basis. And I'm not exactly sure how this is all going to reconcile. We have a lot of really interesting changes going on in the structure of the market. And so I want to make sure that we're light and nimble and we don't take anything for granted because I don't think it's a no-brainer. Investing is not a no-brainer. It's a lot of work involved looking at these indicators and these charts and these relationships, every single day or several times a week. Well, I'm 100% certain we're going to be okay. 100% certain that the market will resume an uptrend. Not exactly sure when. I also would like to talk quickly about the stock market in terms of lending. All right, I'm going to share my screen with you, and then we're going to wrap this up. Let me just hit pause here. I'm sorry for the delay here. I'm kind of a fresh podcaster. So if we bring this chart up, let's do a Google search for Wilshire 5,000 plus GDP. The Wilshire 5,000 is an indicator, an economic indicator of the total production, the total output and economic engine that drives the U.S. economy. The Wilshire 5,000 calculates the entire value of all the stocks that are traded in the U.S. The gross domestic product, GDP, is our economic engine. So you can see here that it's a 2.01, which means it's 201%. The stock market is 200%. It's double the value of the economic engine that drives it. I'm a little bit concerned with that. At the same time, you have to see, for the most part, since roughly 2013, we've been above 1.2 or 120% above the market. So while the trend continues to go higher, and I'm not saying it can't go any higher, what I'm saying is my concern is that we have so much market value built into the economic engine that drives it. Even if the economy does really, really well, I'm afraid that we're not going to see those gains really manifest themselves in the stock market going forward. So there is some market there's some risk in the stock market that I'm concerned about. And this is one of the reasons why I've been discussing long-term care insurance. This is why I've been talking about chronic care, which we are all going to need in the future. So why not take some of this overvaluedness that the Federal Reserve has given us, this printing press that's been going crazy for the last 4 to 6 years? Why don't we take some of those gains and just make a horizontal shift, a tax-deferred shift over to long-term care, because we're all going to need it. And most baby boomers are turning 65, 70 years old, something they're going to need. So just something to think about. Perhaps we're going to have diminished gains in the stock market going forward. I think we're going to see a higher US dollar. Gold, I'm not a huge fan of right now. And again, we just have to be careful and cautious. And if you have someone you'd like to share this video with, feel free to send it. I appreciate the referral. This is how our business runs. So have a great day, Bill Ulivari, cenaclecapital.com, and we'll do another one of these in a few weeks and keep you up to date on what's going on in the market. Thank you. Bye.